When you take a look at Asian stocks, they're up, 19.5% since the lows in March. They have dismissed all the dire data. Why do you think that, earnings is going to make a difference?
So I'd just like to break that into two bits, Haslinda. First, it does make sense for markets to have rallied from their lows back on March 23rd. And the key reasons would be a tapering of infection curves. And I'm sure everyone's familiar with the idea that China was first in that area, and that we've seen clear signs of the virus being under control, largely in North Asia. We can get to sort of second wave issues in a moment, but clearly there was a tapering of those infection waves, and that means that the so-called left-tailed risk becomes more bounded. And obviously, in the China data, we've seen a pretty strong recovery domestically there. So the first thing is that markets are forward-looking, and when you see the virus data begin to moderate, that is certainly supportive. Second, we've seen very strong policy support. Third, we've seen some encouraging news headlines, not much factual detail, but encouraging headlines on therapeutics. And fourthly, we had very oversold market conditions. So that it is a rally from those lows makes sense. Our concern is that the rally's gone too far, too fast, and that really does intersect with the earnings questions you've just asked. And it just seems to us that the consensus numbers, which have come down, are still way too optimistic. Even last week, with some further declines, consensus is now expecting flat to down 1% earnings in 2020, and then a further 20% rise in 2021. Our numbers, in contrast, are minus 22% this year, and then a strong recovery next year. But overall, over the 2 years, we're 19 percentage points below. And what that means, to draw this point home, is that markets, we think, are extended in their valuation in terms of how optimistic they are about a recovery. And if you have the sort of headlines coming in about either second wave infections or rising geopolitical risk, et cetera, it just seems to us that the risk reward is more toward the downside in the near term.
So if stocks are looking expensive, especially when you take a look at the S&P trading at the highest in about 2 decades, what do you do? Do you sit on your hands? Are there markets which are, I guess, oversold? So
our sense is, in terms of more specific strategies, would be severalfold. One, in the short term, for those investors who are able to, some sort of hedging of downside risk seems to us to make sense, especially with volatilities having come down, therefore the pricing of downside protection having come in. For those investors who are longer term in their focus, then our sense is that within the market, there are some very attractive themes that we continue to like. For example, in the Asian region, we have a variety of baskets that are up on Bloomberg, and they emphasize the themes such as secular and stable growth, the companies with more reliable earnings, companies with stronger balance sheets, and companies that have a secure dividend yield given the lower for longer interest rate environment that we're in. So there are definitely areas of the market that we like overall, and we would recommend to longer-term investors. Our just sense is that we're probably going to see some downside risks to the overall level of the indices in the near term.
Tim, just go to one side for a second and have a look at palladium, gold, and silver. We're seeing silver and palladium up nearly 6% at the moment. Big gains also for gold. Normally, these are havens, and we see money flooding into them. It's not really happened so much this time, but we're seeing money going into these. Does that have any read-through from an investment point of view? Are people actually now getting a bit scared and perhaps hearing your words here about things going up too fast?
Well, I mean, Rishaad, gold has been relatively stable, and gold, of course, is the long-standing, through many thousands of years, store of real value. I think one of the themes that's in the market, and I've been talking about this with investors on multiple occasions recently, is that there's concern that with effectively unlimited quantitative easing that we're seeing in the United States or in Europe, et cetera, that there's concern about ultimately currency debasement as you have budget deficits blown out and as I said, significant expansion in monetary base, and therefore gold tends to be the relative safe haven in that environment. So I think that would explain some of the underlying demand for gold. For silver, platinum, palladium, and so on, the prices of those particular metals does tend to be more geared toward or driven by underlying demand supply for the industrial or other usage of those metals. They're less considered or traded as a pure store of value. So I think that the story driving those would be somewhat different than that for gold.
And overall, the virus is one thing, and then this war of words between Washington and Beijing has kicked off. It's getting more and more vociferous here. Now, is that going to be the big wall of worry for the markets as opposed to the pandemic as we also get and move towards the November election?
Well, we do think that that is a near-term fresh downside risk, Rish. And we noted this in a piece we did a couple of weeks back that, and this goes back to Haslinda's question about the markets kind of looking through concerns about earnings and so forth. So what would it be that could bring them down? Our sense on the downside catalyst, beside those EPS downgrades, would be a slower, less powerful macro recovery. So if the market's pricing in a pretty strong V-shaped recovery, if there's any sense that that's less powerful than the market's expecting, then obviously there could be some sell-off on the back of that. Second infection waves, which we touched on, so-called second-order effects like bankruptcies or unemployment and credit stress. But then to your question, the last catalyst would be intensifying U.S. friction along trade, or now it's topical along the technology frontier with further constraints on semiconductor shipments to Huawei in particular. So that is likely to remain in focus, as you mentioned, in the lead up to the U.S. presidential election in early November. And so I think that is a kind of a fresh intensification of a risk that the market had become quite complacent on. Just finally, in terms of how we monitor that on a daily basis, we have an indicator, again, it's up on Bloomberg, which is our U.S.-China trade tension barometer that is based upon how various segments of the market are pricing. And that was up at a quite optimistic level of 95% a few weeks ago. It's still high, but has begun to tip over, and it's now just suggesting sort of an 85% probability of successful trade outcome. So it looks like the market is beginning to price this risk, but hasn't sort of fully done so, and that's why we think there may be some further downside along this axis.
Tim, I want to take a look at oil. It's rallied, and investors are expecting a rebalanced oil market by June, July. How do you play the theme of oil?
Well, thanks for asking the question, because it's something that our commodity strategists have been particularly focused on. We were quite bearish on oil, and now we think that the market's beginning to rebalance. And of course, we've seen a rally in oil from the spike lows that we saw a few weeks back to trading in Brent terms around about low 30s per barrel. Just on Friday, we released a new updated sector views piece for Asia, where we neutralized our underweight, our longstanding underweight on energy and chemicals, the related sort of energy areas. Even after the rally that we've had, it's still the worst performing sector year to date. And importantly, we reckon that the energy stocks are discounting a current oil price of about $35 a barrel. So I think they've priced in the recovery that we've seen, but we don't think they've priced in some further improvement and rebalancing in oil. So our commodity strategists think that oil could be higher next year. We think that potential further increase has not yet been baked into the stocks. So we think that there's still some margin pressure on the downstream stocks, but the upstream ones are, if the oil does as we think it will be somewhat better. So on balance, we're neutral to the sector. We think that from a stock picking standpoint, there's some opportunities within it.